Right, well, I think we've hit 12:30. Welcome, everyone. The eagle-eyed amongst you will have seen the date on this facing page. Apologies for that. It isn't the 6th of May, if we're confusing you. And for those of you that are interested in obtaining a copy of the document at the end, it will obviously have today's date on. I'm James Murphy from Park Lane Plowden Chambers. Abby Telford is also, I think, probably on your screens now. Now, reading round this morning for a bit more background and to perhaps look at very recent changes to some pension matters and or pension news, my eye was caught by a document from the government services suggesting that the way to get people interested in their future pension rights and savings was to make it really interesting. Well, apologies, I don't know how interesting this will be in terms of entertainment, but hopefully you might find it interesting when considering a claim. This talk is pitched both for claimants and defendants, and I trust there are people on the line from both. What myself and Abby were suggesting is we will go through our part of the talk, stop the recording so we're able to put it onto our website if anyone were to be interested to look at it later. And after the recording stops, we would be very keen to hear from you as to any comments, observations, experiences, or indeed questions for either the two of us, or obviously for other people on the call as well. So if we get right into it now, pension has become quite a hot topic really at the moment. My eye was also drawn this morning to a suggestion given to a Common Select Committee that about 54% of the populace that haven't got enough money and they don't have enough plans to have enough money to enjoy their pension retirement, or what would be considered a normal pension retirement lifestyle. I dare say it's not true for all of you on the call, but increasingly, with the loss of these defined benefit schemes, which you will know as final salary schemes, particularly leading to the requirement, which we'll go on and have a look at in a minute, of auto-enrolment, there's obviously been an erosion over the years of what were fantastic pension schemes to be a member of, final salary schemes, and even now for particularly government employees, for whom generally these are only really open to. The odd big company still has them, but nearly all employers, including the government now, have refined the final salary scheme because, of course, they don't believe we can afford it, particularly if it's underwritten by taxpayers. Final salary schemes obviously have been around for donkey's years. They're the generic original occupational pension scheme. Obviously, at the time and most commonly, both the employee and the employer will contribute into it. And it generally follows a very simple formula, which we will go through in a bit more detail in a moment, which is how long you've worked for an employer, what your pensionable earnings are, gives you, and then the formula, which used to be 1/80th, but we'll see there's been some alteration to that, which will give you your annual pension. Of course, over the years, and particularly perhaps over the past 25 years, normal pension age from people, believe it or not, used to be 50 in some occupations. It's still 50 for some, such as firefighters and police service personnel. It's now thought to be 67, 68. Some of you are probably so young on the call that sadly your anticipated retirement date or pensionable age date will probably be about 70, if not 72 or 73 by then. But final salary schemes have to be borne in mind, because even though you're probably less likely to come against them these days for a client, or indeed if you're for a defendant, it may well be, particularly if you're doing a fatal claim, that some part of their pension entitlement over the years have been obtained from the membership of a scheme such as this. The final part of today's talk will also touch briefly on state pensions, which effectively are similar to this sort of scheme, but they come from national insurance contributions, or if you're on benefits, the benefit agency will make it up. Again, actually, it's been in the news in the past few days that there's going to be, it would seem, quite a substantial increase in the state pension next year of £1,000, which is worth bearing in mind if any of you are in the throes of putting together a loss of state pension claim at the moment. So this is what we're more likely to be engaged with these days. And I dare say for all of those of you on the call who are an employee with an occupational pension, you're most likely a member of a defined contribution scheme, which is in common parlance called a money purchase scheme. If you have a quick look at the heading here, I just want to draw your attention to the fact that we tend to talk about pensions, but in some ways, and it's not my phrase this, I've lifted it from somewhere else, obviously, a better perhaps way of looking at it, particularly in terms of calculating losses, rather than thinking of it as a pension, which really brings to mind something like a final salary scheme, thinking of this head of loss as a source of income in later life. I'll explain why in due course. But a defined contribution scheme, it's a shame because it has a fairly similar title to a money purchase scheme, which is defined benefits, is effectively personal work saving plan called money purchase scheme. Generally speaking, both you and your employer will pay into it, but there's some employments where only the employer pays into it. Obviously, because it's dependent upon the stock market and investments, matters such as that, and of course things that are going on at the moment that you can see and you'll read and see in your papers all the time at the moment, the annual pension's less certain depending on the eventual investment return. But we don't need to worry about that, of course, because this is a claim for loss. And what we're looking for when we do this, and I'll show you a bit later on how it's calculated, is we're looking for the missing contributions from income and for the equivalent of income, i.e. the employer's contribution payments into a scheme, not the hypothetical outcome in 20 or 30 years' time or whatever. So if you're thinking of putting together a schedule, you read a schedule suggesting that if this person pays, I don't know, combined £3,000 or £4,000 a year in with the rate of return, etc., over the next 20, 30 years, it'll be worth whatever. Well, that's not the way we do it. We obviously work in today's money, as we'll see in due course. So that's defined contributions. Now then, this is effectively the same thing, but this has obviously caught everyone's attention quite a lot in the past few years. I think everyone's clocked onto the fact that lots of people, particularly those in less stable employment, self-employed or the gig economy, haven't really put anything by for their later years, and that's why the government obviously brought in National Employment Savings Trust, NEST, as it's the acronym helpfully spells. We all know it as auto-enrolment. It's been about for the past several years. It's obviously compulsory for all those over 22 working in the UK earning over £10,000. There's different amounts, but at the moment it's 5% of employee and 3% of employment of qualifying earnings as a minimum. I won't bore you with what that means, but you can very quickly find that if it's relevant. One or two things that are worth bearing in mind, though, about a NEST scheme is that opt-out is possible. I suspect that's going to become more difficult as time goes on. But even though it had a lot of fanfare, and I think the reason why it had a lot of fanfare was because, of course, there was a prescriptive element to it, and prescription particularly for employers as well as employees. But at the end of the day, it is, of course, just a money purchase scheme conceptually. So most of you will be very familiar with some of these phrases, but it's worth bearing them in mind when we speak in a little bit more detail in due course about how to look at the different types of schemes that you may come against. The first is actuarial reduction. For the reasons I've already said, regrettably, this is probably less likely to be realised by many of us than perhaps was previously imagined. But it's still not uncommon to have cases where the claimant did intend retiring less than their anticipated retirement date. Well, let's just use 67 for convenience at the moment. And if they wanted to retire at 62, for example, then an actuarial reduction is a reduction in their pension receipt if they decide to take it early. So that does happen quite commonly. I think at the moment it seems to be extremely common for those sorts of employees working particularly in the health service. I don't know if it's a similar experience for most of you, but I've particularly noticed in the past year or several that many healthcare professionals, perhaps particularly nursing staff, midwives and the like, it's not uncommon for them to get 20, 25 years under their belt, retire at say 58 with an actual, or whatever the age is, with an actuarially reduced pension. They then go back on bank work and effectively working bank work without pension contributions, making up the difference. So they can effectively earn the equivalent of, or very close to the equivalent of, full-time income made up of an actuarially reduced pension, but also choosing to work in their old job effectively, bank work in that way. It also happens for people who leave the police force, for example. Most of them do 30 years up to age 50, give or take. But it's very common that if for some reason they might have otherwise joined the police force late, because obviously people don't have to join at 20, occasionally you do get people who leave at 50 anyway, so they haven't banked the maximum numbers of years, so it's reduced, but they then become a civilian working back in their old job. Obviously not on the front line, but if they're, as it were, on the control desk or whatever else, again doing a similar sort of thing that midwives or nurses may do. So it is actually fairly common even now, and perhaps I would suggest becoming increasingly common for people to be working slightly more flexibly, using their pension, their actuarially reduced pension, effectively as an ongoing source of weekly income, topped up by doing another form of work, particularly if it was their old work on bank or whatever. Commutation, that's cashing in some annual pension for a bigger lump sum. We'll show you how that's done in a bit. And then the other thing to bear in mind, of course, and if you're not quite sure what your state or normal pension age is, if you go to the pension website, it'll give you the bad news that it's probably slightly older than you were hoping for. Actually, even now I do from time to time put in someone's date of birth, and it's slightly different even now, depending on the age for a man and a woman, to see what the normal pension age is, or the state pension age is, forgive me, because sometimes it does surprise that it's slightly higher than it was anticipated. Right.
So I take over here in terms of common questions and issues that arise when you first get a pensions claim across your desk. And the first thing I'd say is, when you know that there's going to be a pensions claim, and your first indication is likely to be if there's a loss of earnings claim, at that stage, get hold of the pension scheme rules, because those pension scheme rules are always going to essentially provide you with the vast majority of the answers you need. Trying to work things out on the basis of wage slips alone isn't good enough. The reality is, claimants in particular are not particularly good at knowing the details of these things. And so going away early doors, getting this information, which means that when you have to sit down and do the maths, you've got those details, it will just make life so much easier in the long run. The government employees rules are available online, and they are administered by the same body, and they're going to tell you things like the normal pension age, the methodology used to calculate the pension, the actuarial reduction that James mentioned would happen, for example, if a claimant decided that they were going to retire at age 62 as opposed to age 67, and commutation factors. And so commutation is where you take the lump sum, but there's always a factor in terms of if you take £12, £1 now, for example, what you kind of knock off the annual income. And those details will be found in the pension scheme rules. They also give you information about when old schemes stopped and new schemes started, which is going to be particularly important when you have got a claimant who has moved from a final salary scheme over to a care scheme, because you're going to need to know when that happened so that you can work out essentially at what point you are moving into the new scheme. The reality is, however, in the vast majority of cases, because of the way limitation and limitation period works, what is going to be most relevant to you is going to be looking at what the latest scheme is. And so in a lot of cases now, that will be a care scheme, because the claimant will receive the older closed scheme benefits anyway, because that scheme is ended. So essentially put a line in the sand there, and everything you're dealing with now is under the new scheme, because that is what the claimant's losses will relate to. The only exception to that is in a fatal dependency claim, where you'll need that information to work out the post-retirement pot for dependency calculations. In terms of remaining questions that you would have, the answers are most likely to be found on payslips or a P60. And so that's always going to be things like what an employer paid in, what, if anything, a claimant paid in, have they opted out, have there been increases, decreases over time, have payments stopped at any point? So somebody suddenly decided that they were going to stop making payments. These are all things that you will need to factor in, because a pensions claim is like anything else. It is based upon the evidence that you can produce to persuade the defendant or the judge that what you're saying is a reliable account. And so if you look at that evidence and the account that you take from that evidence doesn't match what your claimant is saying, you are automatically going to know, whether you're for claimant or defendant, that there are going to be issues with that claim. And so it's pretty fundamental to kind of go back and really cross-reference the account that you're being given with the information that you see in the documents.
You can also get, if you can't get your hands on all of that information, perhaps particularly if it's fairly early in the claim, or the claimant comes to see a solicitor reasonably shortly before limitation, and you're trying to drag everything together in order for an initial schedule of loss to be put together, or you're a defendant, you have quite a lot of information from the claimant, but you don't have an awful lot. But you get hold of, this is for either side, secondary pieces of information, I would suggest, which can be very useful. One of them, of course, is if you have a case where the claimant has been ill health retired by an employer, either a defendant's employer or otherwise, because of their accident or otherwise, but usually it's because of an accident. It can give you quite a lot of useful information, particularly if you can't get your hands very quickly on the scheme rules, because quite often, particularly if it's a privately administered scheme, there can be quite a delay in getting the rules, for the reason Abby was saying, the claimants quite often haven't bothered keeping them, getting them out of the administrator, and sometimes there's a bit of argy-bargy about whether you've got the most up-to-date rules as well. Now, an ill health pension receipt documentation, and if you work for the government, it's usually really detailed, actually, if they're ill health retired, you're a big employer as well. Now, of course, we ignore ill health pensions in terms of calculation of loss or whatnot, but if you have that information, it will tell you quite a lot of stuff that you really need to know if you haven't been able to glean this from other sources. The first one, of course, will be how the pension's been calculated. The ill health pension is highly likely to have been calculated in the same way as the present, most likely care scheme or whatever it might be. It'll tell you whether the claimant commuted or not, even though it's not necessarily the case that an ill health retired claimant who commutes wouldn't necessarily have commuted in 10 years' time, say if they'd got to age 67 without an accident. I think if a claimant commutes with an ill health pension, it's probably indicative of the fact they may well have chosen to commute, but for the accident further on. It doesn't really matter. It makes the calculation of loss slightly more involved. But if you are working out what the deficit is, i.e. what the but-for loss is, it's rather easier if you're doing the calculation to assume a similarity, either the claimant did or didn't commute, because then you're just taking away the difference one from the other. But it will tell you, of course, whether the claimant has chosen to commute on ill health retirement. Very relevantly, and this is something that you need to know, just in case you fall into error with any calculation, or if you're trying to work out the value of the loss for a defendant, it's very useful to know whether there's been an ill health enhancement. To be candid, this doesn't happen as much as it used to. It was very generously done for those who worked for the government back in the day. You do still get occasionally ill health enhancements now, but you don't get the 5 to 10 year enhancements you used to fairly routinely see for people who worked for the government, say 5 or 10 years ago. But the reason to know about an ill health enhancement, of course, is that if, for example, the claimant was 2 years away from their normal retirement age and their ill health pension had been enhanced, then on the face of it, of course, that can extinguish or reduce a a pension loss claim, because of course you still have to suffer a loss. It's not about setting it off against loss of earnings or anything silly like that. But it's useful to know about that, because, and there were cases, you know, where people would have enhanced by 5 or 7 years. Well, it would look like, you know, that their pension was a huge sum of money. But if you could work out really what was the original pension up for 20 years, say, but it's been enhanced by 7 years, and then you'll know exactly where you are as to what the deficit is. And if you're saying that they would have worked for 40 years, then the missing period, as it were, is 13 years. So it's a useful secondary piece of information. Very often it's actually the thing claimants have to hand, because fairly often they've just been ill health retired, or they're going through the process of ill health retirement when they're seeking legal advice, because very often the accident goes hand in hand with the requirement for that. But bear in mind, I think I touched on this already, bear in mind when you get this sort of information, or if you get the scheme rules, or you get the annual forecast, because you will quite often be given an annual forecast. The annual forecast is very useful, again, to give you the nuts and bolts of how a scheme is administered or organised, and to give you an idea of how much a claimant may or may not have paid in for the preceding 12 months. But of course, very often they will be forecasting what the person will receive as an annual pension, say in 20 or 30 years' time. We don't use that to work out the annual pension figures, because we work in today's money. That's what the discount rate and multipliers, etc. for. But if you ignore that for a moment, it will give you, again, if you don't have ill health retirement documentation, and or you don't have the scheme rules, if you get the annualised forecast, and most employees should be given one once a year, it will at least get you quite a long way along the task in putting together or analysing a claim for missing pension by reason of having to give up work early. Right. There's some other information you can find, some useful answers to very pertinent questions, really, because the most important thing in terms of loss of earnings claims, and of course pension claims, because obviously pension claims arise from a loss of earnings claim, of course. It's important for both sides to have a look at personnel records, occupational health records, medical records, and medical reports. I think whether you're for a claimant or a defendant, it's very important to try and glean what the claimant's intentions might have been before they were injured. And often it's found within such documentation that they, particularly if they're getting on a bit, I mean, if they're 25, I don't think it's particularly relevant when they thought they might have retired, because they might have expected to have won the lottery or something like then. But if they're 59, for example, it's not uncommon that you'll find a comment made that intend, you know, retiring at 62 and then going on bank, for example. And it's very useful, whichever side you're on, to get a very clear idea of what the claimant's intentions were prior to an accident. Doesn't mean they definitely would have done that. But it would at least put you again along the lines of putting together an accurate, and accuracy is very important for obvious reasons these days, an accurate claim for loss of earnings up to whatever date that was going to be, and for a loss of pension if you've obviously losing pension consequent upon your accidents as well. So it's useful in that regard, but actually probably more likely to be found is it's more likely to be useful for promotion, demotion, career change, etc. And very often you will see comments made about how much someone's enjoying their job or otherwise. Doesn't necessarily mean they would have been able to stop being a barrister or a solicitor or whatever, but you can get some idea of that. You will get some idea about their, you know, motivation to be promoted or otherwise, and or indeed you'll get some sense of how they got on if they sought promotion or otherwise beforehand, because of course promotion is not only relevant to loss of earnings, but of course self-evidently is very relevant to any lost pension claim as well.
Okay, so it's back to me to deal with the final salary schemes and the formulas that we follow. James introduced these earlier, and I think it's fair to say, given the sums that were being paid out under the schemes, and in particular the large lump sums that were being paid out that we come to shortly, that they in fact caused quite intense financial pressure, which resulted in many of these schemes being closed to new members, existing workers being transferred onto new schemes, and so they're building up new pensions on top of the old ones. But if you come across one of the final salary scheme pensions and you have to do your calculations, they're actually relatively straightforward. And the reason they're straightforward is because you look at the pensionable pay at the end of the career, so the final salary, and that is your starting point when you do your calculations. So in a fairly straightforward way, if you just deal with the annual pension loss, if you had a £50,000 final pensionable pay, so somebody is retiring and that is their pay, and they had a 1/80th proportion for each year of their career, and so that would again be found in the scheme information, and we know that they had a 40-year career, you take that £50,000, you times it by the 1/180th, times it by your 40 years of career, and that gives you a £20,000 per annum gross pension. You think to yourself, okay, that's a reasonable pension, but on top of that, they also get a lump sum, and we'll come to the lump sum in a moment. If you're calculating a loss of pension under one of these schemes, therefore, where you have got fewer years of service because somebody has not been able to proceed with their work because of an injury, then the calculation is carried out in this way. You take your £50,000, you multiply it by your 1/80th, and then you multiply that by your number of years. The first section you can see there, A, is the calculation we did on the previous slide, which is your but-for pension, and B is your actual pension, so what they actually took because of their illness or injury, and so 29 years in this case, and you can see that the difference there is between £25,000 and just over £18,000 pension gross each year. So your loss is £6,875. It's a fairly straightforward calculation between what they would have got and what they're actually going to get to calculate your loss. But you mustn't forget the automatic lump sum that they are entitled to in any event. And in this situation, in this case, we know that they're entitled to that automatic lump sum. The factor is it is 3/80ths, and we know that 1/80th is £25,000 from our previous slides. So in this case, your for lump sum is £75,000. That is what they would have got were it not for the fact that they've had to retire early. But we know in fact that there is an annual loss of £6,875. And so we calculate that by 3, which is giving us the 3/80ths to give you your missing lump sum factor. So again, it's what they would have got, what they're now going to get, you multiply one from the other and you get your automatic missing lump sum. On top of that, however, you have to factor in voluntary commutation. Because a person has the option of voluntarily commuting some of their pension. And so you can commute a maximum of £25,000 of your lost annual pension. So in this case, we know that the £6,785 annual loss can therefore be multiplied by 25%. And the commutation factor that we talked about earlier on, which is if you take £1 now, essentially, or take £12 now, what is it taking off your annual salary? Your annual pension. That is kind of the factor that you are carrying out to work out the commutable lump sum. So here it's £6,785 times 25% gives you 1,718 times by 12, which is your commutation factor, gives you the commutable lump sum of 20,616. You have to remember, however, that you have to take off the annual loss, the 1,718 per year, because you're getting that lump sum now, which means you're going to be taking a factor off the end. So that leaves a £5,156 in terms of your annual pension loss. You apply a multiplier in terms of that. We have adopted a 20% reduction for tax, but of course it may vary depending upon what a person's other income is and the like, but you would see there that you have an annual pension loss of 44,617. So taking those together, you've got the annual pension loss overall, which is the total pension loss really, and then the lump sum, which you add together and you get £65,296. That's the total pension loss under your fixed final salary scheme. You then come to the care pensions, and if you have one that comes across your desk, the first thing to note is that there is no automatic lump sum entitlement. So that £75,000 that a person was automatically going to get under the old scheme, that they're not entitled to under one of these new schemes. And so if you have somebody who has never been under a fixed final salary scheme and is now only having a pension under a care scheme, they're never going to be entitled automatically to that lump sum. They can still commute part of their pension, and we'll come to that shortly, but that is something that is the biggest difference. The other key difference here is that your pensionable earnings reflect the actual earnings that you have in the individual years throughout a career rather than the earnings at the end, and the pension grows incrementally as a consequence. And so what you have is the proportion of your actual earnings is applied to each year of your earnings over the career. For example, taking a teacher as an example, it's at 1/57. How does that work in practice? So the example we have here is a teacher who's aged 50. They're earning £50,000 per annum, and then national state pension age is age 67. The scheme accrual is 1/57th of the gross salary for each year of active membership. So for every year that they're actively teaching and earning, you get the accrual of 1/57th. In our case, we say that the teacher would have retired as a teacher at age 61. And so in the claim that we're dealing with, we say that he has got 11, we're saying he's got 11 years missing. And so your calculation is 11 times 1/57th of £50,000 is £9,649, which is your baseline assumption of loss. But in our example case here, the claimant says he would have been promoted, and he says he had a 100% chance of that. We say that actually when you look at a claim, you again have to go back and really consider the likelihood of somebody having that promotion and whether or not that would or would not have happened. And for the purposes of this example, we're saying that actually it's more likely that there was a 25% chance of that promotion happening in 3 years. And had that promotion happened, his salary would have increased by £10,000. And so what we need to do is we need to add in an additional factor for his loss of pension to account for the 25% chance that his income would have increased by £10,000. You take your 11 missing years and you deduct 3 from that, because he wouldn't have been promoted for another 3 years. So that gives you 8 years of loss at this potential higher salary. You apply the same factor of the 1/57th, and you add in, and then you multiply that by your extra £10,000. But the important factor is to multiply this by the 25% chance that this would have happened. And as you can see, it makes a fairly modest difference in terms of the increase to the lost pension of £351, which when added to the baseline comes to a total loss of £10,000 in terms of loss of pension. I pause there for a moment because while we've mentioned it previously, it bears repeating that for whichever side you are on, interrogating a claimant's medical records, interrogating a claimant's employment records, these sorts of things are really important, because if you're for a claimant, they might well give you evidence that will increase your 25%. And if you are for the defendant and you are trying to minimize the losses here that you're going to have to pay out, you might well be able to persuade a judge that actually the evidence just didn't match up with the claimant's 100% chance that he says that he would have been promoted. And so it is that thing again of going back to the evidence and really analysing what it says by reference to what the claimant is saying. We have to adjust, however, the figures, this £10,000, because as the claimant would have retired before state pension age, there's a further adjustment to reflect the early drawdown. Some schemes have a bespoke actuarial factor built in. Go back and check the schemes. They're really clear when they do have that. But when they don't, the scheme should still provide a standard reduction factor, for example, 3% per annum, which will then allow you to adjust the figures back to the assumed retirement age. So in our case, we know that the lost career pension figure needs adjusting to reflect early drawdown, so further reducing, which means that we have to adjust the national pension age of 67 to reduce it down to 65 initially, because that's in line with the scheme. So we reduce that by 2 years at 3%. So your multiplier there is 0.94, which gives you 9,400. But that only takes us back to age 65. It doesn't take us back far enough. We then need to pull back the calculation back to age 61, because that's the assumed retirement age on part of the claimant. So again, we apply the actuarial factor from the relevant scheme to reduce that back. And the actuarial factor in this case is 0.817. So because you have already made the adjustment from £10,000 down to 9,400 using the initial adjustment, you're then taking the 9,400, multiplying it by 0.817, giving you your total loss, which is £7,679. Commutation is what we mentioned earlier on in terms of the fact that a person can voluntarily choose to draw down a portion of their pension at an earlier date. It is, again, a case where you need to go back and you need to get the evidence, the information from a claimant as to whether or not they would or would not have commuted. For the purposes of our example, we work on the basis that the claimant has chosen to take the maximum commutation. And the maximum amount is usually a proportion of the gross annual pension. And so in our case here, we've got, you can see it's 30/7. You have to remember, you don't get this as a matter of right, it is a choice rather than anything else. So again, it comes back to what the claimant says and what information they might have given to other people about potentially wanting a lump sum and that sort of thing along the lines. But we know that in this case, the claimant is going to take the maximum lump sum. So we do hear our calculation of our previous loss, which we had here of £7,679. You multiply it by the commutation factor of 30/7 to give you the maximum lump sum of 32,910. But we know you also then have to reduce your annual loss by £1 for every £12 of the lump sum of taken. That's your commutation factor. And so the 32,910 is divided by 12 to give you 2,742. So you take your £7,679, which was your initial loss, you reduce it by 2,742 to account for the commuted sum that you've taken out, giving you your gross annual pension loss of £4,937. The additional factor to bear in mind, which is dealt with in a slightly different way, is the survivor's benefit. Most of the pensions will have provisions in terms of a survivor's benefit for what happens if somebody survives the person whose pension it is. And in those circumstances, the proportion of the benefit will be fixed under the scheme, but it is based upon the full pre-commutation gross pension. So you don't carry out these calculations of commuting the sums down. You also have to bear in mind that the period runs to the end of the scheme members, from the end of the scheme member's life to the end of the survivor's life. And so in this case, we were working on the basis that the appropriate factor here is £10,000, and you multiply that by 0.375 to kind of get the calculation. But the difficulty is, and the thing that we have to bear in mind is, you have to be alert to if a surviving partner has comorbidities. So ill health, age, those sorts of things that mean that they might not survive the claimant in any event that can knock out part of the claim. Also bear in mind the life expectancy difference between men and women. And so depending upon whether your survivor is a man or a woman, really have a look at those life expectancies and identify whether or not they are likely to be a real difference. Because if you can't demonstrate the difference between the life expectancy or the difference between when somebody would survive, that will again knock out that portion of the claim. what we then have to do with all those lump sums that I've taken you through is you have to apply the usual multipliers to work out essentially what it's going to be, because as James has said, all of our maths has been done in today's money. And so if we're doing all of our maths in today's money, you apply the Ogden calculations and multipliers in the usual way that we do with future losses. With your loss of gross annual pension, you use the pensions multipliers. The Ogden table are very helpful in this regard. And we can see from the calculation there that once we've taken off a basic rate tax, and we've assumed there's other income taking us over the personal allowance threshold, that the total there comes to £100,000 or just over. In terms of the loss of the commuted sum, there is no deduction in terms of the tax there, but you do still have to apply a multiplier, and you have to apply a multiplier to account for the fact that the commuted sum has been received 11 years earlier than would otherwise have been the case, because it would have been 11 years before the claimant would have taken his pension and commuted a sum in any event. And so it's not the pensions multiplier you apply, it's essentially an accelerated receipt multiplier. And in this case, that's 1.0279, giving you the sum there of just shy of £34,000. And then finally, in terms of your loss of survivor's pension for life, you again have to factor in the tax. So you have to make the reduction again. And the multiplier you apply here is the difference between the husband and wife's life expectancy, life multipliers. So again, you just look at the tables, you identify what the husband's multiplier or the surviving spouse multiplier is and what your claimant's multiplier is, and you apply that factor to work out what your total sums come to. We can see in this claim that we add it all together and it comes to a grand total of 145,771. But we pause there for a moment, because imagine if we had an additional lump sum in the way that we did with the fixed final salary schemes. You can see it would have been a significantly greater claim. James.
The other factor we have to do in most true situations, of course, is bear residual earning capacity of mind. I should say, by the way, just when I was listening to that part, we were using a teacher's scheme rule of 1/57th. Just to bear in mind, it's not true actually that all government employees use 1/57th. There's a whole range, funnily enough, which is all available online as to for each reckonable year, what percentage of your annual salary get. It'll reassure you to know that the government employees who benefit the most from these schemes is, of course, the judiciary. I won't make any further comment, but they benefit from the best annual amount going into their pension. And there's one or two oddities actually as to who does less well, even though everyone works for the government. You'd rather assume it would be 1/57th for everyone, but it isn't as it happens. So don't assume, by the way, if you come to use this in the real world, that you have a government employee and therefore it's likely to be 1/57th. It may well be. But if you just go online, you can find very quickly out. There's a table actually you can find that sets out what they all are, including people, for example, who work for the armed forces and whatnot. Most cases, apart from the most serious cases, or of course if someone's died, but most cases involve the question of mitigation of loss. It's obviously relevant to loss of earnings. It's very common, of course, unfortunately, for whatever reason, for a claimant not to yet be in mitigated income, either because they've only just been dismissed by their employer or terminated by reason of whatever capacity or ill health by their employer, or they just have found it difficult to get a job, or they might be waiting for further operative treatment or something. But it's very common that everyone assumes, all the doctors assumes, after all of those events, the person will, of course, be able to go into mitigated income. So it's not particularly any different to how you approach it for a loss of earnings claim. Previously earning £30,000 a year, now can only earn £20,000 a year in some mitigated income. Well, the loss per year, leaving aside the Ogden calculation for a moment, the basic loss is £10,000 a year, of course. It's slightly more complicated, or requires a little bit more thought in mitigated income, particularly in the situation which I think is probably most commonly encountered, that the claimant hasn't yet got a job. This is especially so if they were working for the government or were benefiting from a care type scheme, which is still very generous in comparative terms. And the anticipation is that them having lost their occupation and then being on the open labour market, they're just going to have to go out and get a normal job with auto-enrolment or the like. Essentially, all you need to do, though, is you're taking one from the other to find the loss, aren't you? So you work out what your basic loss is following through Abby's methodology, depending on what type of scheme it is, or auto-enroll scheme, doesn't really matter. And then you look at what the sort of job they might do in their mitigated income, and you work out of that, and we'll come on to how it's done on a money purchase scheme in a moment, and you take one from the other. You have to be very careful, and this is why it's worth looking carefully at pay slips. You have to be very careful if your client is in mitigated income by now or by the time of your calculation. Be very careful to work out exactly what the claimant, him or herself, is paying in, as opposed to the employer. There are still many employments where employees don't make any contribution themselves, and they get a very generous contribution from an employer. And also, occasionally, you do get a situation that even though the scheme rules say the employer will pay, say, 6% in, for some anomalous reason, your employee, I beg your pardon, your claimant, in fact, is getting, for example, 14% paid in. This is either but for the accident or in subsequent employment. So you've got to be very careful that you calculate the either actual mitigated income pension money going in or the notional amounts going in, because otherwise there's going to be some inaccuracy between your loss of earnings figures and your pension loss figures, which we'll hopefully talk about in a moment. Right. So money purchase schemes, this won't take as long because these are really just a bank account. I think it's conceptually easier to think about a money purchase scheme as just a bank account or some ISA or some saving policy effectively. The truth about final salary schemes or care schemes or whatever else is that, you know, you and your employer, for every year you agreed that you would work as an NHS midwife or something, you would get 1/40th of your final reckonable salary, and all the rest of it, as Abby demonstrated to you a moment ago. And then you would get that per year for however long you were to live after your natural retirement age of 65 or whatever else. And there was a calculation to be done, and we have to do it in the methodological approach that Abby has shown you. It's a bit easier actually in a money purchase scheme because really, whether it's private scheme, many of you listening to this call will have your own private pension scheme, which will doubtless be a money purchase scheme, or you have a pension scheme through work, or what's called a pension scheme through work, it'll just be a money purchase scheme. And all it is really is it's a way for both the claimant or the employee and the employer to put money aside that they've already earned to live on later. So effectively, if you pay 3% of your salary in and the employer pays 6% of your salary in effectively that you don't get, it's just 9% of your weekly income rather than going into your bank account, is of course going into this pension scheme. The real difference between private and work ones is, and just make sure in your loss of earnings claim, is that if you have a private, because some employers just have private schemes and they don't pay into them, or they're required to do so. If you're on some kind of strange contract, you do occasionally get it. You just got to make sure that you're allowing for whatever that percentage is, either in the earnings loss claim or in a separate pension loss claim, just to make sure that the claimant isn't getting over or undercompensated. But the real advantage to work schemes, and this is why people are encouraged to join them, and obviously auto-enrolment rather demonstrates this, even though that's not overly generous, is that the employer makes contributions as well. If we go on to the next screen, you'll know this probably from most of your own personal experience or having dealt with many cases like this. The slight problem or the slight drawback with a work scheme is, particularly now, is there's less flexibility than if there was a private scheme. But there's some advantages to it. You can often decide to increase your percentage contributions make additional voluntary contributions, AVCs, and again, the wage slips will demonstrate that, or the annual forecasts will demonstrate that. And don't forget, of course, the wage slips will also demonstrate things like share save schemes, or you know, if you're paying for a bike or a car or something via that method as well. But you can learn information from, say, a pay slip as to voluntary contributions made. Well, a voluntary contribution into a money purchase scheme is just a salary sacrifice, effectively, isn't it? So instead of getting 5% of your salary into your wage slip every week or month, you're actually saying, well, rather than give it to me now, let's put it into my money purchase scheme because I'm quite content to leave it there. And there are maybe other advantageous reasons for me to do that. It's very common for people as they get a bit older and perhaps have a bit more excess money to start maximising contributions into AVCs. So it's worth looking at that and seeing what difference that makes. But this is the concept. If we just go back one stage, Abby. But this is the conceptual point I'm trying to hammer home. Even though it's routinely called lost pension for the reasons described, it's not really that, it's lost income. You're only actually putting more money into a pot, and therefore if you've lost it, you've got less money in your pot. Whereas the care and final salary schemes, there's a missing component in the computation. So there's a missing element of the calculation for which you're trying to seek compensation. But all here is, it's your scheme pot, as it were, or your bank account is just missing the amount of money you and your employer haven't been able to put into it because you've been off work or you've lost your employment. So I've already said this, that you and your employer is just putting it into this bank account. You've got limited access to this bank account. It usually has investment rules attached. You can't get it early, for example. But generally speaking, claimants or employees are advised, and generally it's true, of course, that there are lots of advantages to being in that. Principally, of course, and this is why people shouldn't opt out, principally, of course, it's because it generally attracts a greater contribution from the employer as well. But at the end of the day, because we're just trying to calculate what a claimant has lost, it's literally the missing sums that the employee paid in, or that's been missing that the employer otherwise would have been paid in, rather than paying it as income. So this is a really, really simple example, but I'm hoping, again, this rather emphasises the point. Let's imagine your claimant's not at work anymore. His pre-accident earnings were as follows: £100 a week he took home. He paid £25 a week into his a work pension scheme. He also paid £25 a week as an AVC, and his employer paid 50% into the scheme as well. So, but in actual fact, for each week, forgive me, he worked, in real terms, his earnings were £200 a week. It just so happens that the money was allocated to two places, £100 in the wage slip and £100 into the scheme, unhelpfully often called a pension. So if he never works again, his loss is going to be £200 times 52 times multiplier, whatever, to his normal pensionable age. But for convenience out of habit, or if there are other complications, the £100 is usually calculated a loss of earning figure, and there's often reasons for that. And the other £100 that's gone into the scheme is often kept separate to that. And the reason why that might methodologically be done is particularly with the mitigated income point I was mentioning earlier on. So very often calculating the two, there's reasons to do them separately. But in fact, what you're really looking at is that the claimant, had he remained at work, he would have been paid, and I use that phrase paid loosely, £200 a week for each week of work. He would have taken £100 home, but the other £100 would have gone into his scheme. And it's really, if it's a total loss claim, it's his missing £100 from his payslip and the £100 that hasn't gone into his NPS that he's looking for the defendants to pay him out. So it's really as simple as that. And I think conceptually, that's the way it has to be done.
Thanks, James. So we conclude with just a whistle-stop tour of the loss of state pension claims. The only reason we conclude in this way is actually that this is an area which is fairly straightforward, but we see mistakes happen with these from time to time. So it's useful just to recap. The thing to remember is that contributions are made by virtue of your national insurance contributions, which are taken from your earnings. The state also contributes, and the size of a person's pension as a proportion of the full state pension of £185.15 per week depends upon the number of years of national insurance credits that have been made at the date of the state pension age. So what does that mean? You need 10 years of qualifying years of contributions before any state pension becomes payable. You're entitled to your full state pension, that's that at the moment is £185 a week, after 35 years. A qualifying year is a year where a worker has been paid or credited with national insurance contributions on earnings over a certain amount. It's currently just over £6,000, and part years don't exist. The part years not existing means it's quite useful for your calculation because it's always going to be a whole number. And so the state pension payable at state pension age will always be a whole number of 35ths between 10 and 35 years, depending upon how many qualifying years you've had. You can have a look. Most people have access to their own loss of state pension claims online. And so you can see essentially, if you look the date that somebody will be eligible to draw their state pension, the number of years until they will have made their full contributions. That's usually the key for your calculation. And you can see on the left-hand side there with my lovely arrow that if you had another 5 years were required to get to your 35 years. And so it is actually fairly straightforward in terms of how it's calculated, because what you're actually looking for with these claims is the difference between the number of contributions or credits that would have been made compared to those that have actually been made. This is where things go wrong, because people sometimes forget that you automatically get national insurance credits with certain disability related benefits, such as employment and support allowance. And so in those cases, you're not going to have a loss of state pension because the credits make up the loss of the contributions. If employment and support allowance, for example, isn't being claimed, but the claimant still satisfies the same statutory test of being unfit for work, they can actually apply for the equivalent credits without drawing the benefit. And so again, there shouldn't in theory be any loss in those circumstances. The calculation, as I say, is straightforward. You're looking for the calculation of the lost contributions to the qualifying years. And note that national insurance contributions can be made on a class 3, so voluntary basis, to plug that hole and provide the necessary credit towards the full state pension. So instead of essentially having a loss for a very long period, all that you're actually doing is plugging the hole in the contributions. If a person is always going to get to that 35 qualifying years, irrespective of the time that they've had off work, they're not going to suffer a loss of state pension. If, however, they are going to, for example, lose 2 years, so they're only going to have 33 qualifying years, but they would otherwise have worked 35, then you're going to just simply need to make those voluntary basis contributions to plug that gap of those 2 years. In terms of this, what that means is your loss of state pension claim is currently capped at no more than £824.20 per annum. That amount will rise slightly within each financial year, but it's entirely predictable because the contribution amounts are published online. And in terms of your schedule, note that some of your state pension contribution losses will be past losses, others will be future losses, to which you will apply the usual conventional loss multiplier. By way of example, you've got a claimant who's injured on the 5th of April 2021. They're no longer able to work and they're not claiming employment support allowance, and they don't fit the criteria. The state pension forecast is that they have accrued 28 of the 35 qualifying years, but they would otherwise have accrued the 35. Therefore, their loss is that they've lost 7 qualifying years. One of those, because of the date of the accident and the date now, is in the past. And so you can see there you've got the £15.40, which is your 2021 to 22 weekly contribution times by 52 to get your annual loss. 6 of those years are in the future. So the current amount annually is £824.20 in terms of what the purchasing value of that class 3 contributions is. You multiply that by your multiplier for your future loss of 6 years, so 6.05, comes to a total loss overall of just shy of £6,000. So it's always going to be a limited amount, and it's always going to be entirely predictable. They're much easier to calculate and much easier to get the information for in terms of working out these sums. They won't be worth a huge amount, but they'll be worth something if somebody is no longer able to work. But the key factor is working out whether those benefits are actually going to plug that gap in any event. James, unless you've got anything to add, I'm going to suggest that we end the recording here so that we can kind of take any questions or comments that anybody may have.
I've just got one final comment to make, which just came to me really when I was listening to that bit there. I think the short point, whether you're looking at a schedule of loss for a claimant or from a defendant's point of view, I think it's always useful to look at the methodology and approach to the loss of earnings claim, both past and future, but for an accident and in mitigated income at the same time as considering the claim for lost pension, because there should be total consistency between the two. And if there isn't consistency, or the maths just look awry, there's probably some errors crept into it, because they should be consistent with one another, for example, promotion or otherwise, mitigated income or otherwise, etc. So even though the math isn't exactly the same, for all the reasons described, whether it's called pension in old money or now, you know, just a money purchase scheme account, for example, it is actually generated money from working. So the two parts of the claim should effectively be sympathetic to each other, in the same way that without discounting factors, the loss of earnings multiplier and the pensions multiplier should be the life multiplier. And if they're not, you've made a mathematical error, accepting the discount for other contingencies. So there has to be consistency in approach to loss of earnings and pensions, because even though we've been concentrating for our talk on pensions piggybacked on earnings, hasn't it? So just as a little ease for all of our sakes, when you're looking at a schedule or a counter schedule, etc., there should be consistency between the approaches to both earning loss claim and any pension loss claim as well. But other than that, Abby, thanks very much. No.
Thanks, James. I'll end the recording there.